presentation I've been putting together for everybody. Past couple days, I'm gonna try to pack a ton of information in it, and I've already got a late start. So I'm gonna go through pretty much the deal flow, from how do you locate a deal, how do you raise the money, how do you close on it, and then how do you execute. So it's gonna be not super detailed on any one aspect, but I'm gonna try to cover every single aspect. So here we go. Quick disclaimer, so some of the numbers you're gonna see and estimates, do your own due diligence, don't just go by what I'm telling you. And then as far as the slides, if you guys wanna take down this link right here, you'll be able to download the same slides that I'll be going through. So that's go.elevatecig.com /close-deals. And then this is what I'm going to cover. So I'm going to go a little bit about who I am, my companies, and then where you should focus your energy in the beginning to find some deals, how to find them, how to underwrite them, then the process from there. So once you underwrite it, if it looks good, how do you submit an LOI? How do you go under contract? The due diligence process, figuring out your CapEx, raising the equity, then engaging your financing, your property management, doing a pre-construction meeting before you actually close, then actually closing on the deal, then executing the plan, managing the asset, and investor relations. So who am I? I own a construction company, JNT Construction, and I also own a investment firm, which is Elevate Commercial Investment Group. I've been doing real estate investing for about 13 years now. Started in single family, did some smaller multifamily stuff, did a lot of fix and flips. And that's actually why I started the construction company, was to scale the fix and flips. And then about 3.5, going on maybe 4 years ago, I decided to put all my focus towards multifamily. I no longer wanted to do transactional real estate where I was going from deal to deal. I was looking to build generational wealth, and invested in a ton of passive deals at first, and then took down some active ones on the GP side. I now have a little bit over 1,700 doors, and my goal is to get to 10,000 doors by the end of next year. So Elevate, this is the Elevate team, and what we do is we focus on value add multifamily, B and C class, heavy value add, true value add deals, where we come in with the construction company, do the CapEx renovations, and add value to the property. JNT Construction is a full service general contractor. We focus mainly on multifamily, our deals and also other investors. And we also do some commercial renovations. And on top of that, we also do some new development as well. This is just some quick pictures of some before and after work that we've done, just to give you guys an idea on how we transform the properties. Some of the clients, some of our properties, some of our clients' properties that we've done. And then first thing, so focus your energy. What I mean by that is, and this is mainly for those that are trying to start into multifamily, rather than being scattered on where you're looking for deals and what type of deals you're looking for, get focused on exactly what type of deal and exactly what area. So as I have here, property criteria, decide what class of property you want to go after, decide what year built it's going to be, around what type of unit size you want, if it's going to be a true value add component, or if you're going to go after more stabilized deals. Whatever it is, just have it, write it down. As you can see here, here's a copy of our actual criteria that we go after. And then location, same with the location, know exactly what locations you want to be in. So for instance, I have here on ours, we want to be, wherever we go, we want it to have over 100,000 in population. You send me something where the population's 8,000, I'm not going to spend a second looking at it because it doesn't meet my criteria. So just don't let yourself get distracted. If you get focused, you're going to find a deal quicker. Then once you know what your criteria is, now you got to locate the deal. So how do you do that? First thing is you got your brokers, your major ones. Depending in the area that you're going after, some of these are they're bigger players in selected areas. And I may be missing one or two of the major brokers, but for the most part, these are the ones here. And then you're gonna wanna pinpoint who's doing the most listings in that area, and you're gonna reach out to them and you're gonna build a relationship with them. At first you're probably going to want to show that you're credible and that you've got a track record. Now, I know you might be saying, well, if I haven't closed multifamily, how am I going to do that? A couple different ways. I mean, if you've been doing single family, you can still use that as a track record. Just the way you present that. And then teaming up with somebody that does have the track record. I'm assuming you're gonna need somebody with that anyhow to get your financing in place. So you might as well start building those relationships as well, and then you can use their track record to show credibility to the brokers. LinkedIn's a great tool. I think all social media is great, but LinkedIn makes it really easy to find these brokers. Then you got straight to owners. So first two deals that we found and closed on was straight to owner. We pulled a list from CoStar and we were cold calling and mailing them. And that's how we got our two deals. We kind of took that from single family, saw that a lot of people were not doing that in multifamily, and we had success with it. Then you've got property managers. If you could build a good relationship with property managers, they're there at the properties. They usually know, for the most part, when something's going to be sold. So they can definitely help you possibly get something off market. And then online, online is tough with multifamily. I've got a couple of them there mentioned, but it's really hard to count on online. It's really a relationship type of industry. And then wholesalers, just don't do it. That's all I gotta say. I mean, it's I don't think they close anything. At least all the investors I know that have closed on multifamily deals, which I know a lot of multifamily owners, and I don't know any of them that have actually bought something from a wholesaler. So I don't know. Maybe if they're on the ground and I just don't do it. Just stick with that. Yeah. Then, okay, so now you got a deal, right? Let's say you've built these relationships and you've got a deal in front of you. You've got to be able to get through it quickly and see if it's even worth taking your time. So, a detailed underwriting is going to take some time to do it right. So this is just a quick and dirty that we have. We plug in a couple numbers that we get. We pull some comps, and it gives us roughly some returns down at the bottom. I keep covering it, but if the returns meet our criteria on our quick and dirty, then we'll dig into it. If it doesn't, then we pass. You gotta know. Another thing is with all the noise and all the deal flow. Maybe right now with COVID, there's not too much, even though I'm seeing quite a bit come up now. But you've got to be able to go through these quickly. If not, you're going to get tied up and it's going to be harder to find a deal. Then let's say you do the quick and dirty and it's looking good. Next step we do is we ask questions. We get some more details because we want to do our detailed underwriting. So this is a list of questions that we send to the broker or to the seller. Now, some of this is pretty detailed and you might get some pushback from them on them answering it, without even seeing the property at this point. But for the most part, if you let them know, hey, look, this is going to allow me to give you a better offer. There's things that I'm not going to have to guess on, so I'll be able to offer more. For the most part, they'll give you a good portion of it. A lot of it has to do with the property and the capex and having a better understanding of the condition of the units, which goes into play with your underwriting, obviously. And then you've got your high-level capex numbers. This seems to be a little bit out of order. Sorry. This high-level capex number should have probably been with the quick and dirty underwriting. But these are just some quick figures. Once again, do your own due diligence as far as numbers, but this is something that works for us. $3K if most of the units are renovated and not too much deferred maintenance. $3K per unit should give you enough to kind of freshen things up. Then if you got units that do need renovations and some deferred maintenance, $6K per unit. If you got several down units and you need quite a bit of deferred maintenance, then maybe about $10K per unit. Once again, this is high level. This would be your quick and dirty. Then you got your in-depth underwriting. So here's when you're actually going to start breaking things down and tying specific numbers to like payroll, insurance, taxes and insurance. I suggest to get a tax professional or tax protest company to actually look at it and give you their opinion. Insurance, I suggest to send it to an actual insurance agent. Those two numbers can kill the deal. So you want to be as accurate as you can on that. A lot of the payroll and repairs and maintenance, we have our rule of thumbs, but we also lean on whoever we're thinking of managing this property, whether it's going to be, we do a lot of GP stuff, and some of our GPs have in-house, so we'll lean on them to check our numbers. Or if we're going to use a third party, we'll start to get them involved as well. And then also plug in all the information you get from the broker on those questions, and come up with an educated capex number. And then that's going to give you your in-depth underwriting. Once you do your in-depth underwriting, if it looks good, that's when we would schedule a property tour. Now, at our property tour, we're pretty strategic with it and efficient. It's almost like a small, I don't want to say due diligence, but there's specific items we want to see when we go there. We have a checklist, and we're making sure we see as much as we can. We definitely want to see all the down units. We want to see, depending on how many vacant units there are, but usually there's not too many. We'll like to see most of the vacant units, or at least one what they call is, I guess, the worst unit, and then maybe a classic unit, and then an upgraded unit. So that gives us a good idea of what we're looking at as far as capex. And it's just an example of the things that we look at. So we're going to look at landscape, exterior walls, windows, the roof. On the property tour, maybe not the roof, unless we see a good reason to. And yeah, plumbing, there's things that you can look at the cleanouts, which are the pipes that are sticking out of the ground, and see if it's PVC or if it's cast iron. If it's PVC, your plumbing hopefully is in better shape. If it's cast iron, you may want to put a little bit more in the CapEx for plumbing. You can get an idea of how old the AC units are. You can look around for the foundation, and I mean, I can spend 2 hours going over what to look for at a property, so I probably need to skip this one. Okay, and this is I'm gonna play a quick video. Try to put it up.
Putting together a renovation rough estimate so that we can numbers and submit an LOI. So on this building, the first thing I'm looking at is it's clearly flat roofs. So definitely going to want to get up there and see what type of condition they're in. It's got sort of a mansard style with wood shingle siding. So I'm going to know right off the bat that's pretty old siding. As you can see, it's got some pieces that are coming off. So we'll have to do some repairs there or decide to.
Okay, so I'm not gonna play the whole video, but that was just to give you an idea. Same thing I was doing. That was a property tour, and that's actually one of the properties that we purchased. So be as detailed as you can during your property tour. Don't just waste the time that you're there at the property. And then these are some just rough numbers for multifamily unit upgrades, and then for some exterior items. I'm not gonna spend too much time. I'm gonna give you guys the link again for the slides at the end, if you didn't get it. So now, once you've done your property tour, so, we decided what kind of property we wanted and where. We reached out to the brokers and the sellers, and we got some deal flow. We did our quick and dirty, found a deal that penciled out. We did a property tour. We did an in detailed underwriting. So everything's looking good so far. Now after the property tour, I'm gonna get a better idea of the CapEx. I'm gonna take all that information and everything we saw, pictures, videos, whatever I've got, and I'm gonna put it into a simple spreadsheet, and it's gonna spit out a pretty detailed number. As you can see, I've got pretty much anything. The good thing about multifamily is that for the most part, you're dealing with the same items over and over again. So it makes it somewhat easy to estimate. This is just the final page. So, I've got a total cost here, and this is that same apartment from the video. Just to give you an idea, this was the rough estimate, and we just completed this project a few months back and ended up costing us right about that. So a little closer to $1 million, but we had a contingency, so it was all good. Then once you have that and numbers still look good, so now it's time to try and get it under contract, right? You're gonna submit an LOI first. That's what this is. It's our LOI. Hopefully that gets accepted. Hopefully they don't tell you highest and best. I hate highest and best, but yeah. Then you get your PSA and you go under contract. Now, once you go under contract, you're gonna want to set up your due diligence. And so when it comes to due diligence, you want to be really efficient. Once again, you want to schedule everything in a timely manner. I'll give you an idea. We did a portfolio of almost 1,300 units. and we were able to do the due diligence in 5 days, and that was inspecting all major components, every single unit. But we had a ton of people on site. There was a lot of scheduling. Yeah, so be ready to walk every unit. I suggest that you do that, and the reason for that is you don't want to miss, mainly you don't want to miss any down units. Sellers are known for hiding these magical down units, and the only way you're going to find them is if you inspect every single one. Then, you can use a mixture of, if you're going to hire a general contractor to do your work, you can possibly bring them in during due diligence. There's third parties that do just due diligence. Property manager can help you with due diligence. So a lot of different ways to get it done. Like I said before, be organized and efficient. And then make sure you get a professional for some of the items. You want to have a professional roofer checking out the roofs. You want to have a plumber actually checking out the sewer lines or whatever you have plumbing wise, boilers. Same with foundation, same with HVAC and chillers. And then, a general contractor should be able to handle the rest of the stuff. As far as upgrades, that's another thing. So a lot of investors don't look at the upgrades when they're doing their due diligence. They kind of they still stick to a rough estimate. I, on the other hand, think that you should be looking at your upgrades. Leave due diligence knowing exactly what your CapEx is going to cost. So yeah, keep that in mind. And then this is just a quick example. This is that same apartment from the other video, and this one's quick. Okay, so that was just showing you how many crews we had on there and whatnot. Then I've got the 5 most common overlooked items. Roofs. Don't just take the seller's word for the roof being installed. Recently, actually get somebody to look at it. Termites. You can run into some termite damage if you don't get it inspected. Foundation and drainage. So don't just check your foundation. Check your drainage as well. A lot of the times, foundation companies won't look at the drainage, so you may have to get somebody else to come and look at that. To me, it makes no sense. A foundation company will come in and lift your foundation, but they won't take care of the actual issue that's causing the foundation to shift, which is usually drainage or plumbing. Then you've got your sewer lines. So super important. I think you should scope every line and know what you're dealing with. That can be very costly. And if you don't have money set aside for that, it could be pretty bad. And then just your exterior walls, balconies, walkways. Take a good look at those as far as structurally as well, not just a quick look from the cosmetic end. Then when you're done with your due diligence, finalize your CapEx and your scope of work. Like I was saying, you should actually know what your scope of work is and what it's going to cost you. And then go in and revise your numbers. Usually your due diligence is your time to, if you've got to renegotiate for something, that's the time. You don't want to try and do that later when your money's hard and you have no leverage. So make sure you take the time, get estimates for things. If, for instance, if there's an issue with the plumbing, make sure you get an estimate for how much it's going to cost. Get as much paperwork as you possibly can, and that's what you're going to present to the seller. I'm not saying that you should be going back to every seller and trying to get a price reduction. I'm just saying when there's a real issue that's going to cost a lot of money, you definitely want to have the backup and be able to present that. Then raise equity. So you need the equity to close on the deal, right? I'm not saying you've got to wait till you're done with the due diligence to start gearing up for that, but you know, you're going to want to decide on what type of equity split structure you're going to have, which usually that's going to happen during your underwriting. You're going to want to engage an attorney to do your paperwork for you. You're going to want to decide what type of syndication. Are you going to do a 506B or a 506C? Big difference there is 506B, you can have sophisticated and accredited, up to 35 sophisticated investors, and as many accredited as you want. And then a 506C, you can only do let me go back. So 506B, you can't market to everyone though. You can only approach individuals that you have pre-existing relationships with. So 506C, you can market it pretty much however you want. Consult your attorney on that though, but the only negative is you can only take on accredited investors. So you can no longer have sophisticated in a 506C. So once you've got that all picked out, then you want to put together your investment summary. You want to pretty much gear up all your marketing to get your equity raised, which, you know, have a landing page. And I just put some of the tools that we use for our marketing. You know, for our landing page, we use ClickFunnels. For our CRM and email marketing, we use ActiveCampaign, webinar hosting, Webinar Jam, and then an investor portal that is where we lead all of our investors to, and they go through the whole process of all the way to giving us the funds through our investor portal. Then you're going to want to engage financing and property management. You're going to want to actually put down the deposit for the bank to go out and do what they need to do as far as the third parties and just get everything going. You want to schedule the third parties right away and pretty much make sure you get them everything they need so that you can close timely. And then kind of the same thing with the property management company. You want to decide on what direction you're going to go in and get them started as well. They should want to interview the staff and just start preparing to do the takeover. Then one thing we do is we do pre-construction meetings. Like I said, we do mainly heavy value add deals, so usually there's a pretty big capex part of it. So we get together with the property manager with the capex. We usually start right with the down units. We get those back up. We increase the curb appeal. We upgrade the amenities, and then you know, I forgot to mention there is harden the property is probably one of the first things, is meaning if there's roof leaks, if there's plumbing leaks, boilers, anything major, we definitely want to take care of those. What doing all of that does is it shows our current residents that we're making a difference. And then as far as the other items, the curb appeal, the upgrades, and that shows anybody that's coming new that obviously we're doing a good job. Then we like to create a love for the community. We do events all the time, even through COVID. I don't know if you can see here, but she's wearing a mask. Easter Bunny obviously didn't need a mask, but that was something we did in April. And yeah, so constantly building that love for the community and making the residents want to stay at our apartments and keeping our turnover down. Then, you know, depending on what your business plan is, whether you got to raise the rents or add other income, lower turnover, increase renewals, lower expenses, so many different ways to adding value. Just make sure you have a way to track all of this, from the CapEx to the rents, and make sure that you're hitting your pro forma numbers, which I guess goes a little bit more into asset management. So once you've got all that, you've got to obviously manage the asset. And I think it first starts with setting the expectation with your property management team, whether it's in-house or third party. We have some in-house and some third parties, and we ask for the same KPIs from every single one of them. And we set that expectation from the beginning, and then we track those on a weekly basis, which is what you see. This is one of our weekly reports. It's got more details than this, but this was just a screenshot. And then these are just some of the KPIs that we want to look at on a weekly basis. And I repeat weekly because the last thing you want to do is manage your asset from monthly financials. You're always going to be late. You're going to be making late adjustments. But if you're keeping track on it on a weekly basis, you can quickly adjust and actually make a difference for that month versus trying to backtrack. At that point, it's too late. And then I believe this is the last slide, investor relations. So once you've done all that, or while you're doing all that, you want to make sure that you're keeping in constant contact with your investors, letting them know what's going on. We take a lot of pride in this. We try to stand out and do things differently. Right here you can see this is a stack of binders with all the property information, and somewhere that our investors can physically put in the financials or their distributions. I know a lot of things are done online, and I'm all about electronic and being online and no paper, but I do realize that for a passive investor, it is nice to physically have something. So we started sending these out, and then we've got our investor portal, which has all the property information and the financials, and everything goes in there. Then we do a CapEx quarterly report, and don't always print them out. This was we're meeting our $10 million investor at one of the properties, so we went ahead and printed it out. If not, we just send it through email. But then a property tour. So this is a quick video of a property tour that we do as well. Keep doing that. Give me 1 second. There we go. I'm not going to show the whole video, but I think that gives you an idea. We invite all the investors out there, and then we show them what I think this was maybe a couple months in, so we showed them some of the stuff we were doing. We walked into one of the units we had upgraded, showed that to them. It was a great turnout and a great event, so we're definitely going to keep doing that. And then let me see if I missed anything here. Financials, CapEx updates. We are going to start doing some Zoom calls as well, probably monthly, and a yearly event. Starting this year, I think we're going to also do a year-end event for all our investors. And that's it. That's all it takes to find and close a deal and manage it. There at the bottom is the link again if you want the slide, and then you've got all my information. You can find me pretty much on all social media platforms. Let me look look here on the chat and see if anybody has questions, if they want to put it in there, if they want to mute themselves and ask, feel free. Okay, so what company did you hire to prepare your portfolios and property tour videos? Portfolio is done in-house, and property tour video wasn't really a company. It's just somebody that does videos, and we went ahead and edited it. That is Houston. Yes, that was Houston in the video. Okay, in the chat, you want me to put the link? That's not a bad idea. So you all have the link in the chat. Oh, somebody was nice enough to, okay. Thanks, Jackie.
Right, I jumped in there because I was visiting the website.
Yes, thank you. Trying to see when the questions started. I think that might be it on the questions. Wait, what are the actions your company is taking due to COVID with regards to the business plan and distributions? Omar, as far as COVID, you know, we've taken a ton of actions. You know, to start, we've become a lot more flexible, obviously, with our residents as far as payment plans. We've had to implement a lot of like for the leasing office, and you got to have your mask on if you're going to come in. All of our employees are wearing their mask. We've set up some like barriers, so you can't just walk right into the office or to somebody's desk. We've put a lot of our stuff online. A lot of our properties, you can tour them, even the property, not just the unit, but you can tour the property online. A lot of texting and emails with our residents. Distributions for our investors, we have paused them just because it seems for the you know, even if the property's performing, there's just so many questions right now. It just seems like the right thing to do. And for the most part, our investors they understand, they get that. And yeah, I mean, there's a ton of other things I'm sure that I'm missing that we've had to implement. Has the occupancy rate changed due to the pandemic? I mean, every single one of our occupancies has actually, physical occupancy has gone up at all our properties quite a bit. Now, as far as collections, they have been decent, but I mean, you know, it's back to the question. We just don't know what's going to happen next, you know, and how long it's going to take for everything to open back up. I was very happy when things started opening back up here in Texas, and Texas was kind of leading the way. And then all the cases started spiking, and yeah, now we're kind of taking a step back. So, you know, it's just crazy times. What are you doing differently with the underwriting now? It's hard not to imagine that vacancy might increase along with bad debt and concessions. We're using the same assumptions as pre-COVID. Definitely not using the same assumptions. You know, we've made adjustments. We continue to make adjustments daily on, you know, even that criteria that I had on there. I mean, that's actually changed. It's not what we're using right now. A lot of so assumptions, you know, we're not putting much of anything on rent bumps unless it's dramatically under the market. Higher vacancy, economic vacancy for sure. And like I said, I mean, we're adjusting it daily, kind of just keeping a finger on what's going on and what the markets are doing and what's happening with COVID. See, I feel like there's another, Yeah, and probably the hardest thing right now is the financing end of it. Even though, if you're getting a stabilized deal, sure. I mean, the rates are awesome. But for these heavy value adds that we're doing, it's the bridge lending is pretty tough right now. So that's been one of our biggest obstacles, where we're working on building more relationships on the equity side, and possibly coming in with more equity to make the bridge lenders feel a little more comfortable. Do you consider to be a vertically integrated company? So I don't have a property management company. I have a construction company and I have the investment company. I think possibly eventually I'll bring in the property management. Not looking forward to it, just because it's I don't know, to me it's a tough business. You're hiring and firing left and right. I like the asset management part of it more than I like the property management part of it, but I think it's one of those things as we continue to scale and grow. So what we've done meanwhile is we've also partnered, co-GP'd with somebody that does have in-house. So we still, in a sense, have a little more control than a third party. But then we do still have some third parties, and on those third parties, we're just resilient with our asset management. I mean, they've got to deliver our KPIs. They've got to be performing. If not, we're going to make adjustments. How and where did you first meet your partners? It's a good question. So one of my partners I met back in middle school. So we've known each other for forever. And then my other team members have been just from networking. I network a lot. I go to a lot of networking events when we have them. A lot of Zoom stuff now. And I put myself out there. I put myself out there on social media, and I'm constantly meeting individuals and building relationships. Man, these are great questions, and they keep coming in. This is awesome. Is the business plan and marketing package basically the same, or are they? Brad, I'm not sure if you're okay with unmuting yourself and maybe asking. I'm not quite sure what you mean by the marketing package, but
yes, the marketing package for the property, the investment package.
so like the investment summary.
Yes.
And the investment summary within the investment summary has our business plan. What we plan to do when we close. Is that? I'm not sure if that answers your question.
Meaning the package you're sending out to your potential investors on the property you have under contract.
Got it. So we're actually not sending those out to potential investors. We're sending those out to the investors. Like once they've invested and we closed, we send that out, usually with some type of gift. And it's some of the investment summary, some of like the basic information about the properties or property, and then it gives different sections for them to put in financials, distributions, and anything else.
Good deal. That's good stuff. All right. Any more questions real quick? Because we got about 10 minutes left before we start our virtual networking. That way you can find your investors inside this group.
There are some more questions here.
Oh yeah, my bad. I miss some. Which one I miss?
Let me see. As an apartment owner, have you received any type of relief from the government? We have. We've applied for PPP and received it on some of my entities, construction company as well. So yes, we have. Property managers as well. Some of the third-party property managers we use, and also the in-house property management. We have received that, and very helpful. 2.5 months of payroll. Do lenders, partners, or equity providers use multiple incentives or penalties? Gene, are you there?
Yes.
Okay.
In other words, do they use basic incentives or penalties to shape your behavior on the project for key events? In other words, there's performance tests like your NOI and your leasing, behavior. Would they give you incentives if you're meeting all your parameters as far as maybe burn-offs?
Yeah, so in our equity splits, we have hurdles built in, which I think is similar to what you're talking about. It's more just based on the returns, on the IRR. So depending on what we meet there, the split changes.
Yeah, that could be certainly one, but I'm talking about as the property improves and you're getting your key events that are working, the lender will sometimes advance more loan proceeds, and these loan proceeds can be used typically to repatriate the equity.
Say replace the
Repatriate.
Got it. No, I'm not aware of us having any of that.
Okay.
Valerie just says thank you. Good. Glad you liked it, Valerie. I don't know. Any other questions?
No, that's it. I just because a lot of times your high net worth individuals will include that in some of the underwriting. It's basically to shape the behavior of the sponsor. They've got more collateral releases, and burn-offs.
I got you, Gene. Yeah, we with our $10 million investor, we have some of that in there.
Okay.
Certain numbers we need to meet. I can't tell you exactly. I'd have to pull it up, but yeah.
Otherwise, it was a great presentation.
Thank you.